So to kick things off, as I mentioned this morning, this next session is one that we're really excited about. It addresses your feedback from prior events and symposiums where we got feedback such as great show, great content, too retail heavy. Want to learn more about B2B? What's going on with faster payments? What's the role of blockchain, distributed ledger, et cetera? So as Sarah and I and the rest of the FinTech steering committee sat down and spoke about this, the bar was set pretty high because we wanted to make sure that in responding to your feedback, we hit the ball out of the park. With that came the challenge of finding a moderator that's very well versed on the topic, and the panelists that can provide a really good level of depth into the kind of what's going on today, what happened previously and what failed, and what are some of the emerging opportunities for all the constituents that are here in the room. With that, I reached out to a colleague of mine at PwC, Tim O'Donnell, and said, you're the best guy I know in the business on the topic of commercial payments and transaction banking. The challenge you have is commercial, depending on how you define it, and the panel will go through this, can be very broad. As Haskell mentioned this morning, if I were to ask everyone in the room, what does commercial payments mean to you, we'll get a lot of different answers. So with that, I'm very excited about this session. Tim brings 25, and he's very careful about how I say this, 25 plus years, he won't give me the actual count, of experience in and around the topic. When you think about his career, it's really composed in three parts. He started out in banking. He ran payment operations for a big money center bank in New York. From there, he left and went to a startup that was trying to seize on opportunities, some of the inefficiencies and challenges in those big money center bank payment operation rooms. Sounds familiar. After living the startup life into the Haskell's world, he went from an A category to a D. He then joined a profession of consulting to kind of share those lessons learned, where he got some scar tissue, to really help today's leaders in financial technology that are trying to solve for some of these faster payment initiatives, do it smartly, efficiently, and with value and impact. So it brings me great pleasure to ask Tim to come up on stage and introduce his panel. I've said the bar is very high, and I know he's going to do a great job with him and the panelists. So Tim, thank you.
Thanks, Jim. We've known each other long enough that he can put that kind of pressure on me with that kind of introduction, but I appreciate it. I want to thank you for your time and the opportunity to talk to you today about a topic that is equally exciting to myself and to the panel here, the topic of commercial payments. And as Jim said, it is often overlooked, the importance that commercial payments has in our overall payments ecosystem. We are overlooked often because we're not the face of the public. We're not the part of the business that gets the snazzy videos with the young lady jogging through the neighborhood. Commercial payments runs behind the scenes and services the large corporates, the governments, the institutions that need to move big blocks of money, either for their own purposes, their clients' purposes, or as a way to settle the transactions that are being set up through card-based, ACH-based payment types. So we feel, the group here on stage with me and myself, that commercial payments deserves an audience such as this. And I have to say, an audience quite a much bigger than the last time I was invited here, speaking on healthcare payments, and I think the crowd could have fit on this stage, so it's great to see this kind of growth at TAG. One thing that hasn't been discussed extensively today is just the sheer size of the industry that we're talking about. And on the slide that's up now, I wanted to share some of the statistics that we gather and maintain around payments as an industry. Some bankers don't even realize that when you add in the net interest income and the fee income, that payments as a product set can account for 40 to 45% of the total revenues of a bank. And of course, this does differ from institution to institution, but on average, this is a reliable figure. The business of making payments is huge, $300 billion in revenue across our industry just for payments in the US alone. And it is growing extensively. We think that over the next 5 years, there will be an additional $1 trillion worth of payments revenue that will come in both on the retail and the wholesale side at a growth rate of about 8% CAGR year over year. Now, we've had to adjust that down slightly the last couple of years because of some weakness in the Far East, but that's a global number of 8% growth that outpaces many other industries that we track. Profits of $80 billion and more, which represents about a 20% margin. So an extremely attractive product for the banks, for the service providers. And it's no wonder that the fintech group is growing and coming after these revenues, given the size of it and given some of the challenges that we're going to talk about a little later today. And it's a global phenomenon. We see rapid growth overseas, 60% of the growth in this industry occurring outside the United States, 20% of that in the China economic sphere. I want to take a little while to define what we mean by commercial payments and distinguish it from the retail payments that we've been talking about quite a bit today. We're talking about payments that are made on behalf of your corporate customers. That's the definition we'll use here today, meaning mostly B2B payments where your corporate customers are either receiving or sending funds for their own purposes, whether it's the purchase of direct goods, the settlement of other commercial agreements, paying their employees, but it is initiated by your corporate client. It's dominated by 3 or 4 major payment types, Fed wires, ACH, debit cards, and to a diminishing degree, checks. But there's still about 18 billion checks written and cashed in the United States every year. And corporates are the biggest culprits. The decline in check volumes is slowest among our corporate customers, and we're trying our best to move them over to electronics with some remaining resistance. We're talking about large value payments, on average around $2 million per payment, mostly 90+% electronic. And each of these payments carry huge data sets, hence the use of ACH, use of SWIFT messages in conjunction with the payment to carry these big data payloads that are necessary for the sender and receiver to exchange in order to recognize the purpose of the cash exchange. We're going to talk today from the perspective of the banks and their service providers when we talk about commercial payments, because that's where the big changes are occurring, that's where the challenges exist, and the related opportunities out there in the industry. And we'll also talk about how the startups, how the new entrants into this space that are labeled fintech companies are encroaching and taking some of the customer-facing solutions and the related revenues away from the banks and from those processors. One thing that is often overlooked is that the commercial operations group is the central payments hub for an entire bank and is handling the clearing and settling of all the payment types that we're familiar with. So regardless of the vehicle, the form factor, whether it's mobile or a card, a check, it is more often than not your commercial payments group that is handling the end of day clearing and settling, whether it be with the Fed, with the local ACH agencies, or with check exchange clearinghouses. So I wanted to put a little context and definition around this. I'm going to spend a few minutes before we turn to the panel talking about what are the overall trends in the industry today and what challenges those are facing to the banks, to their service providers, and how the fintech group is exploiting that in some cases or solving problems with and for the banks in the same space. When we think of commercial payments, we have to recognize that it's affected a great deal by macroeconomics. Rates will determine whether a corporate will keep their cash idle in a deposit account or whether they're going to move it into interest-bearing instruments. And the speed or the acceleration in the economy will determine whether cash is withdrawn from the banks and will be used for capital improvement projects. So the macroeconomics will affect the deposit rates that are in banks that generate those net interest incomes, and also will have an effect on the fee income that the banks get to take in. Risk and regulation, you cannot have a discussion about payments without talking about risk and regulation. The regulators are not easing up on their requirements in this space. And an interesting challenge that the banks are facing is to support those regulatory requirements while they become more innovative, introduce new products, and go into new markets. Globalization increasingly is a part of this product. The ability to support cross-border payments, foreign exchange, is, as we pointed out before, becoming more and more important as our overall economy becomes more global. For the banks to be able to support payments, they're doing it on aging infrastructure. The core payments systems are getting older. The underlying technology that they're built on is obsolete. And at the same time, they are having to introduce new innovative solutions into the industry and compete with these startups and non-banks that are more well-capitalized, more nimble, faster moving, and get to market with fintech products that the banks have difficulty competing with. Industries are demanding more specialization. A healthcare client expects to be treated like a healthcare client and not an industrial products company or a oil and gas exploration company. That specialization is difficult for the banks to achieve and maintain and deliver on a day-to-day basis. Their corporate customers are looking for increased efficiencies. They want to shrink settlement windows. They want to tighten up integration. They want more straight-through transaction processing. And this, more and more, is putting burdens on the banks to leverage technology and shrink their own settlement windows in order to achieve the client's results. The transaction itself is becoming commoditized. There's several decades now of this business where the systems have all become standards. The standards have become well standardized and adopted. Differentiating yourself to your clients oftentimes means leveraging their information and industry information to provide data analytics, forecasting, benchmarking to those customers as an add-on to the transaction processing that you're doing for them. But most of all, quality is an ongoing challenge with the shrinking time windows, with the innovation and new technologies. Customers are starting to differentiate their corporate banking by how well they react in exception situations, how well they are treated on a day-to-day basis, and how the bank treats them as a valued client. I wanted to now turn to the panel and discuss some of these emerging trends and challenges before we get into the opportunities. So I'm going to take ladies first and pick on Christina. And as you think about these trends that we've been talking about, I'm wondering if you could just, for us, take the customer's perspective, the end user, because I've been spending a lot of time talking about what goes on inside the bank, but we all have customers. We worry about their experience. Maybe you could take a little time in the context that we've just gone through and talk about the end user and the importance of serving them.
Sure, he picked me first because I coughed during his presentation. Excuse me. I think that we can't ignore the fact that the end user, the business end user, is also a consumer. And for years, we've watched this convergence of consumer and business end user expectations. Business users expect to be able to conduct and manage their business with the same types of intuitive applications that they use in their personal lives. And when you consider the changing dynamic in the workforce as well, as a new generation of business leaders moves up in the corporation, you've got these tech-savvy millennials who grew up on technology. They expect technology to simply work, and they expect technology to solve their problems. So with those dynamics, we have to think about how we deliver products and services. More than ever before, that evolving customer expects simple, easy to use, easy to implement and integrate types of tools and solutions. And they'll have a continuing declining tolerance for archaic back office applications in the finance and accounting areas and for manual processes. So though historically, commercial payments adoption of technology has lagged behind consumer, I don't think that's going to change, but I do think that the clip at which this rising set of new leaders, the next generation of leaders, will adopt technology will speed up. And driving that change will be process efficiencies and a reduction in complexity in the back office.
You know, I've just realized I need to stop for a second because in all my enthusiasm here, I skipped over a very important part of our presentation, which is to give these distinguished panelists a chance to introduce themselves. I have it right here on my agenda and skipped over it completely. So you've heard my introduction from Jim, but maybe I could ask Collin if you could introduce yourself and then work down the panel, and then I'll start again with the questions.
Sure, thank you, Tim. So I'm Collin Flotta, and I work for a company called Acculynk, and I run product with that corporation. And the echo there. So with Acculynk, what we do is we're a very debit-centric corporation, and that we're helping a lot of corporate customers out there, as well as merchants and others, how to use debit cards in order to affect payments and how to increase that speed for whether it's day sales outstanding, whether it's paying small vendors, large vendors, or even, you know, in an Uber case, how do they mass pay all of their drivers in an on-demand instant capability?
Yeah, so my name is Oliver Belin. I'm Vice President of Receivables Financing at PrimeRevenue. So you can hear from my accent, I'm not from here. I just recently moved to Atlanta. It's an amazing place to have such an event here. I've never seen such an event in Europe, but coming back to my person, so I have 15 years experience in the commercial payment space, in financing the supply chain. And I'm working for a company called PrimeRevenue, based in Atlanta. I think one of the fastest growing fintech companies. Today in Georgia, for example, we just increased by double our workforce in the last 12 months. And what we are doing is, I think, quite interesting and intriguing. We solve one of the key problem, which everybody has, is as a company, how you get paid faster by your clients, and on the other side, how you can extend payment terms to your suppliers. And with a key goal to improve your working capital and have more liquidity. So we do that on a global scale. For example, last year, we processed over $120 billion of transactions. And we do that disrupting the marketplace, working with almost 50 financial institutions, like, for example, SunTrust or other banks, which I think are part of the audience today.
And I'm Christina Hall. I lead business development and product strategy for TSYS Commercial Services. I've been in the payments industry for about 10 years and have held various roles throughout the company. And we have the pleasure of serving some of the largest commercial issuers that issue commercial credit and are a market leader in commercial card payments and processing.
Hi, good afternoon. My name is Ross Tulloch. I head up product strategy for SunTrust Bank within the wholesale side of the bank, within Treasury and Payment Solutions. What my role is to really try and help define the market needs of our customers in 3 to 5 years from now. As you were saying, Tim, in your opening remarks, the banks are very much focused on NII revenue, but also fee-based revenue. And with the emergence of the fintech companies, where does it make sense for us to partner in order to stay relevant and deliver overall working capital needs of our clients today?
Thanks for those intros. Thanks for making up for my gaffe there. I know how Steve Harvey felt there on the stage. I did want to come back to Oliver and have you talk a little bit, given your perspective on this. We have to remember that a commercial payment is a result of a very complex transaction often that involves suppliers and buyers. and also involves the need for liquidity at certain points in the transaction. Could you talk a little bit about commercial payments in that context, in the whole global economic event that occurs?
Yeah, so thank you for the question. So I would like to go again back to the basics. So as I said before, with a company working with its trading partners or customers on one side and the supplier on the other side. And going back to the trends, which is a key topic now, I would say I would focus on 3 trends which we see right now. So we work with very large corporations like Heinz, Kellogg's, Volvo, Whirlpool. And what we see throughout the last years that all these companies have working capital or general payment terms, DSO, DPOs, I'm sure you heard these words, as a key metric in terms of corporate value, in terms of how efficient they manage their company. So if you're a strong, large corporate, that's good news for you because you have the leverage. You can impose longer payment terms, for example, to your suppliers worldwide. And we see that, for example, in the food and beverage industry, where there's a trend recently since 2 years where payment terms moved from 60 days, and today the standard is 120 days. We see the same thing in the telecommunication industry, in the automotive industry. So for smaller companies, of course, it's a huge issue because they don't have the leverage. And that leads to the second trend, so how they get financing. And there also we see a change. So with ongoing regulations in the banking sector, like Basel III, banks on a global scale are more focusing on investment grade, well-rated large corporates in terms of financing. If you go down the food chain with less rated companies or even non-rated companies, you pay a huge premium to get financing, or you don't have access at all. So this is where the second trend comes, the third trend, the last trend, which I see is where fintech companies get into this space, solve the issue of general payment terms, and allow, on both sides, large corporates to improve their working capital for their shareholders, for the value of the company, but also the smaller companies worldwide, the suppliers, to improve on their side their working capital and cash flow.
And Collin, I want to come to you and talk a little bit about card, because when we talk about commercial payments, we talk about purchase cards, but more and more the card platforms, networks, and cards themselves are becoming useful for commercial transactions. So we don't want to ignore the card business, and when we talk about commercial transactions, in fact, it's a huge part of our industry, and I wondered if you could talk a little bit about that.
Yeah, absolutely. So what we're seeing is a big trend in the industry as a whole. Traditionally, as everybody knows, card payment was consumer to company, right? And most times we refer to those as merchants. And what we've seen over the last couple of years, as there's been an increase in the demand for speed of payment, is there's really this gap between ACH and wire. And there's really nothing to fill that void. And what we're seeing is more and more the card networks themselves are realizing that they have the entire infrastructure in place to basically reverse that flow of money, right? So rather than consumer having to pay money to that merchant can easily mass pay or push funds out to whether it's a small vendor, medium vendor, whether it's on-demand type services, things like that. There's this massive need to pay all of these people, and there's that gap between ACH that takes a few days to get to people, and it's not real time, it's not on demand, and wire that has a lot of costs, a lot of fees, and other things with that. And the card networks have been they're in the right position at the right time to enable that. So we see both Visa and MasterCard starting to get into that, as well as the regional, local EFT networks here in the US. Globally, we're also seeing this trend as we see local debit networks globally, whether that's MPCI in India, whether it's FPOS in Australia, Interact in Canada. They're absolutely focused on this industry. It's one of the only new true payment products that's rolling out to the industry as we see right this second. Huge opportunity out there as this segment grows and to fill that gap between ACH and wire.
So just another example of what's changing and what's changing very quickly in this part of our industry, and the ability to keep pace with that change, the ability to innovate and to keep up with those more nimble, smaller companies that we've talked about today and under the banner of fintech is something that is difficult for banks, admittedly. Historically, they have not been rewarded for innovating by Wall Street, by the analysts, by their clients. Banks, being risk averse, did not invest heavily in risky propositions. They didn't compete well with innovation. They tended to compete themselves down to zero revenues on anything that was new, hence free checking. But we see the tide changing and the culture of banks changing and becoming more innovative in different ways. And Ross, I know you wanted to talk a little bit about how banks are changing that culture, how they're changing even their operating models to enable innovation from within. So if you could spend a couple of minutes on that.
Yeah, absolutely. You're right. We're in a very heavily regulated industry. We do have compliance and risk and certain responsibilities, whether it's FinCEN or Financial Crimes Enforcement Network. So that being one theme that is not going to go away, if you look at what banks are traditionally doing from a reinvestment of maturing capabilities or product innovation, you're typically looking at anywhere between 4 to 8%. If you look at, as a result of that, what Visa is doing, what MasterCard is doing, or Wells Fargo, other banks setting up centers of excellence or their own labs where they can work in partnership with emerging fintech providers. So that capability can then be harnessed into core treasury or wholesale needs as banks look to grow fee-based revenue to become the operating bank of our customers. What we've done recently at SunTrust is, because there is such an explosion within the fintech world, we've actually stood up our own fintech and digital payments function, whether that's from an investment standpoint or whether it's through a partnership. There's actually a gentleman in the room, one of my colleagues, Eric Brewer. If you want to track him down, he'll be happy to tell you more about what we're doing there. But knowing that banks' ability to innovate to the customer's needs from a time, speed of execution perspective, it's limited. So we are having to look at the market and customer needs and identify those fintech providers that can give what the customers are wanting from us. It's not just from a credit perspective or an operating bank perspective. It's also giving them the tools and services that they're needing to improve their overall working capital perspective, whether it's on the disbursement side, the receivable side, account opening, or account access perspective.
Thanks. We work extensively with banks and their desires and plans to innovate. And the leading practices that we're seeing in the industry, which I know SunTrust also follows, is to be very inclusive from the very beginning, meaning innovation centers can become encapsulated and siloed, and when they discover a new technology, get the budget to do some small proof of concept, that proof of concept often withers quickly after the innovation group drops it. And the leading practices we're seeing in the industry is by bringing in your risk people, your IT, your operations group, regulatory compliance at the very beginning, and have them in a cross-functional way work with your innovation center. The chances of success, the chances of something meaningful coming out of the innovation center become that much greater. And I know that those are practices that SunTrust is following also.
Just to add to that point as well, Tim, I think the banks are really looking for that net new revenue growth opportunity, as opposed to what traditionally may have been the case with build it and they will come mentality. And so that idea of forming strategic partnerships where you can actually have an incubator, you show the net new revenue improvement to then go back and then pour gas on that investment in order to deploy that to the market.
We talked a little bit about the challenges that are facing the industry, and one of them, which Collin's pointed out to us in our earlier discussions, has to do with not necessarily competing with the startups, with the innovative companies, the fintech companies, but supporting them in their payments needs. And in these days where more and more payments are flowing through an Airbnb or Uber, to quote again one of our more popular fintech companies, the banks now have to support very innovative market-facing solutions with payment capabilities that leverage the infrastructure that they've built up over decades. So Collin, I want you to expand on the conversations we've been having within the group on what does it mean to a bank to now have to support a company that is market-facing, that's generating huge numbers of transactions that would have gone through other channels previously?
Yeah, so I think what we see in the industry from our perspective as an innovator is that a lot of these companies and a lot of what's going on around, whether it's, the gig economy or whether it's Amazon's instant delivery and stuff, just the overall expectation, whether it's the company or the consumer at this standpoint, is that I should be able to have anything and everything I want almost instantly, right? So I can order from Amazon and the product will be at my doorstep before I can even drive home practically. So why is it that why is it that these commercial payments have such a long tail on them as far as being able to execute in mass and being able to see settlement and all the things that they're used to in their normal day and their normal life? We're seeing a lot of competition in and around this gig economy around how to affect that out to their kind of micro vendors, whether it's the driver or whether it's the landlord at an Airbnb. How do they get payments faster? We're even seeing it from a little more established type economy type individuals, such as like a Ticketmaster, right? So now I can go on Ticketmaster and I can resell my tickets. Well, I want my money and I want it now, right? For the tickets that I just sold, it shouldn't take me 3 to 6 more days before I receive those funds. And that all kind of flows back into this commercial arena with the banks. And as you said, Tim, it's been a long tail. It's been a long time building out commercial payments, and now all of a sudden it's being turned on its side, and they have to support things that they never supported before. And that's why the banks, it's imperative that they support these functions and functionalities and innovators such as ourselves coming into the market. And the innovators themselves need to some extent, try to work with kind of the infrastructure and make that all kind of function together so that we can get to market very, very quickly with products to satisfy these needs.
One of the big challenges out there in servicing these aggregators, if you will, is living up to the know your customer and AML type of restrictions that the banks serve under today. And when you're separating yourself another step from the end customer, there's technical challenges, right? Regulatory and operational challenges to living up to those regulatory reporting requirements when Airbnb is giving you anonymous payments or Uber is collecting and passing on payment information that you need to store and report in accordance with your regulatory requirements. So whether it's a PayPal or WorldPay or an Uber, this is an extreme challenge for the banking community. How do we serve these aggregators, these end user service providers, and at the same time live up to our regulatory requirements? Coming back to that topic of innovation that Ross was just talking about, whether the need to innovate is forced on you by a client like Uber or Airbnb, as we were just saying, or whether it makes its way out of the innovation center, there are other constraints that we put on ourselves. We're our own worst enemies sometimes in getting these new ideas out to market. And Christina, I wonder if you could talk from a processor's point of view as part of the ecosystem, what can banks do to break down the barriers or to lower the gates in getting these innovative solutions from concept out to market?
Sure. Well, I'll actually echo some of the comments that you and Ross just said a few moments ago around the need to develop cross-functional teams and really bringing in our internal risk partners, whether it's legal, info security, vendor management, into the process earlier. I don't know about any of you, but I've sat in ideation sessions where just the mention of info security will shut down the creative process. Or, someone will say vendor management will never let us partner with that startup. And, we have work to do. We have to overcome some of those attitudes. And I think that when addressing the silos within our own organizations, we have a responsibility to reach across the aisle, if you will, and really help our risk partners understand the context for the innovation or the partnership that we're seeking to pursue. And really try to work with them to understand that the risk of hazard or loss that our organization faces is only one aspect of risk that we have to manage. As innovators and as strategists, we also have to manage the risk of opportunity. And that balancing act is important. And it really requires probably more collaboration internally than most of our organizations, at least in traditional financial services, have really done in the past. And so we really have to step our game up and work more closely together to meet the needs of the end customer and to keep pace with fintech.
Thanks, Christina. You mentioned security. And as we deal with change, as we deal with innovation, we also have to deal with the fact that the fraudsters, the bad guys, are clearly moving from the low-hanging fruit that they've enjoyed over the last couple of decades, which is now being pulled away from them. EMV is an example of cheating the fraudsters, taking away the opportunity to take money illegally out of the system. So as bad guys do, they're going to find the weakest link. They're going to find that chink in the armor or that back door. And we see clear indications that commercial payments is the next low-hanging fruit for these people. The number of fraud instances on ACH continue to rise. Wire processing fraud continues to rise. And from the same groups around the world that were before attacking to get millions of card numbers are now looking to get DDA numbers or even general ledger numbers in order to get money out of the banks and through the processors for their own benefit. Ross, we were speaking earlier about this topic, and I'm wondering if you could talk a little bit about the steps that the banks need to take for this payment type to mitigate the chances of fraud and other sources of loss around this.
Yeah, thank you. The banks are in, we're trying to help improve our customers' overall working capital. We know there's an emergence of faster, real-time, secure payments. Companies are looking to banks or to providers in the industry to help fulfill that need. Whether it's around least cost routing or AP payment outsourcing. At the same time, we are still expected to follow KYC rules and regulations, whether that's with our customer or even their trading partners. And so given that their trading partners may not be customers of SunTrust or any of the other banks, we do need to make sure that as we help drive payments from paper to electronic, that the right amount of validation and verification is placed around supplier enablement in order to drive those payments. So if you're talking about company X, I can do things like leverage Dun & Bradstreet if you see what Clear Exchange has done with early warning. If you look at some of the fintech providers out there, whether it's AvidXchange, whether it's Vendorin, Boost, Priority, et cetera, it's not just a one piece to solve what's going on from an imposter fraud perspective. It's a multi-layered approach that the banks and the fintech providers needs to be doing. And I think what early warning and Clear Exchange have done is great on the retail side. I think there's more to be done as it relates to wholesale payments or commercial payments. But I think there's a way to navigate around the rules and regulations that are imposed on the banks and my colleagues here, that we can still drive that enablement as well as faster, secure, real-time payments.
And Oliver, I want to come back to you because as banks, we have to manage our risk, whether that's credit risk, market risk, operational risk. And you've heard all the challenges that the banking industry is facing on the commercial side. Inevitably, that risk and mitigating that risk gets pushed back to the clients. We want to slow things down. We want to take more risk-based approaches. We want to have more risk-based pricing to those customers, and we want to tighten up credit and market risk as much as we can. And Oliver, I want, if you could, to talk a little bit about what that's meant globally to the client when you look at the commercial transaction that has to take place.
It's a good question, and I want to come back to Christina about the collaboration. So it's not only about collaboration between fintech companies. What we see in our space about payments, again, you need always two parties in commercial payments, is the collaboration between corporates or companies themselves. So in the past, financing was mainly focusing on one particular company. And when you speak about credit risk, the risk was mainly looked at one particular company. So what has changed now, and it's mainly, I would say, companies were always looking at their risk in their physical supply chain. As you may remember, Fukushima was a huge problem. There was huge disruptions on the physical supply chain for a lot of corporates. But now, just recently, for example, there was a company in Germany called Collin, was a very large supplier of the roof of the Mini Cooper. So they were a key supplier of BMW, and because of unfavorable payment terms, commercial payments, they went bankrupt. And okay, you can say, I don't care, it's just another supplier or another company which goes bankrupt, but it had a huge effect on the whole supply chain of BMW. So they couldn't deliver and produce any cars anymore for several months. And this is what now large corporates are looking, how they can work together in a collaborative manner to not only look at their own financial strengths, but also working to improve payment terms together with their supplier. And the risk approach from banks, then they're looking at approved invoices from these large corporates, looking at their mainly investment grade risk. And by doing so, they can provide one of the cheapest financing available to these suppliers worldwide. So that is one of the key approaches right now. And to give you another figure, there was just a large bank who did some research, and about 70% of the Fortune 500 companies have such programs today in place where they use their strong credit rating to support all their suppliers worldwide.
Thanks. I want to change directions a little bit. I hope you're hearing among all the talk about doom and gloom, the challenges, the suffering that banks are doing, that in fact there are equal number of opportunities ahead of us. In fact, the pressure that the economic crisis placed on us, the pressure of challenges from the fintech industry, growing fintech providers, has reinvigorated this part of our industry, and we are starting to move on opportunities in ways that we haven't before. I talked about rates and other macroeconomic effects have driven the banks to reinvest in their commercial payment products, new innovations to attract those deposits, to be able to charge the premium-based fees instead of becoming commoditized and shoved to the back as baggage handlers for all of these sexy new companies. The risk and regulatory world has put unprecedented pressures on this part of our industry, and we've reacted well by creating new business models where risk gets involved in new product definitions, in the business as usual daily operations in ways that they never did before, and enables them to mitigate risks to a greater degree than ever possible. Banks are leveraging new channels overseas to expand their international product capabilities. They are investing in APIs and digitizing the corporate experience, moving to not past laptops and past webs, but to iPads and other devices to get the corporate treasurer more engaged in his banking products and enable him to get information and actually transact in new and different ways, specializing by industry and creating new efficiencies by certainly outsourcing, but also partnering with these fintech companies to speed up the transactions and to make the interaction with the corporate customer more efficient in many ways, leveraging data to create new products. So a myriad of opportunities that the banking community has reacted to with new products, new capabilities, new operating models, And I want to turn back to the panel to talk a little bit about this. With first sort of an open-ended question to Ross. With your years of perspective on the industry and knowing what we know about the near future, what would you list as the top 2 or 3 changes that we can expect in this part of our industry in the next 5 years?
Yeah, I think I think companies are realizing that maintenance of all of these trading partners that they're doing business with the emerging different payment types, same-day ACH, there are still some checks, some wires, some card, supply chain finance or trade financing, that companies are going to be looking to their banks for total working capital improvements, whether it's around AP outsourcing or AR outsourcing, least cost routing, take the file, you execute it on my behalf, and I want real-time reporting to apply to my system of record for cash positioning, reporting, whatever it may be. And so I think from the bank's perspective, it's not going to be about selling checks or ACHs. It's bigger than that. It's about how can you improve companies' overall liquidity to grow their business and focus on their core competencies and leverage banks where they see fit. And so the banks are going to have to, in order to remain relevant, is to identify those key providers by vertical, by industry, by market, in order to deliver the bank needs of those customers for them to focus on what they want to do best. And recognizing those benefits, delivering those innovative changes is going to take the industry working together in concert. I think that's something that we can all agree on. However, in the last few decades, we've become as an industry more and more fractured, more and more specialized in the segment of the transaction that we take care of. And Christina, maybe you can talk a little bit about how we're going to harmonize among all the different players, how we're going to leverage these new standards to deliver a cohesive product really to the customer.
Right. Well, I think one of the biggest opportunities in B2B payments has to do with the data. The data may very well in and of itself be the product. Downstream from working capital, you've got various players on the AP side and on the AR side who operate in contention and have their own pain points to deal with that aren't necessarily around the payment itself, but the activity that takes place around that payment. And one of the most compelling things I think that the Fed's Faster Payments Initiative may bring to the table is not so much the faster payment itself, but really the potential use of the ISO 20022 standards to harmonize all the fragmentation and to create standards that will work for both sides of the house. And really, it's not just about embracing the standards, but also enforcing the standards. I think that's where we'll find success at bringing some ubiquitous data usage and data standards that will minimize or maybe even eliminate some of the back office heartache that's felt by accounting clerks who are manually entering or rekeying some of the upstream errors that have taken place around the transaction. And so what we really want to try to do is minimize some of that manual effort in the back office and streamline processes from end to end.
And Oliver, again, coming back to you for a wider perspective on the whole commercial ecosystem here. What do you see as the opportunities to overcome this fragmented, disparate industry that we've created when you look at, from the customer's point of view, their need to conduct business?
Yeah, so I want to add to Chris. So something very, very special, which I think it's unique. It's normally governments are always the last one to pick up on a trend, correct? And so 2 years ago, the Obama administration launched a supplier pay initiative. So we went there. Unfortunately, I didn't see Obama, but went to the White House, and they launched this event with, I think, 48 corporates, so the largest companies in the US, to improve payment standards, to improve payment terms. And the key perspective or the key issue to solve there was that if these smaller companies in the US get paid earlier, they have more liquidity, they can invest in job creation, in innovation, in growth. And this is very unique that governments are stepping so early into such an early space like the fintech space. And now the same thing happens in the UK. David Cameron, the UK Prime Minister, invited, I think, 20 corporates. They all implemented such unique programs to support the economy, working with corporates and their key trading partners. It was just last year at the event with the Dutch government. So it's going on, and it's really moving this fintech space, this specific fintech space on payment between large corporates and their supplier to the total different level. It's a really new trend.
And talking about moving to a new level, one of the major changes in the industry today that we've referenced a couple of times is the shrinking of the settlement window. Our corporate customers have never had much patience with 3-day, 4-day settlement cycles because this is working capital for them. Around the world, and now here in the United States, there's an ongoing effort to shrink the time that it takes to settle these transactions. It started with check and the imaging of check and is now moving to electronic payments with the emergence of faster payment schemes in the UK and India and so forth. We are behind, and behind surprisingly many developing countries, but the change is coming. It's clear now that settlement times are going to be shrinking dramatically, even for corporate payments in the future. And Collin, I know you're heavily involved in these initiatives. Maybe you could shed a little light on what this will mean for our corporate customers and the products that we're offering them.
Yeah, so I think what we're seeing is a lot of it is the industry, the banks, and others recognizing, and to some extent, trying to address those needs of those corporate customers and make sure that they stay healthy, they stay happy, in servicing their customers rather than just pushing additional products out there to them. So as you mentioned, globally, we're seeing it as they shrink these payment windows. We see it as the governments are starting to try to figure out how to properly regulate and try to influence the industry into moving in that direction to faster and faster payments. We're seeing it with, whether it's ACH trying to go to same day, whether it's SWIFT trying to do, faster, more fulfilling solutions around their wires and international wires cross-border. We're seeing it with the networks themselves in supporting those cross-border. But at the same time, as Ross was saying earlier, a lot of it comes down to KYC, a lot of it comes down to AML regulation. How do you know these customers? How do you properly vet them? How do you flow that information in an automated manner to where it's not intrusive on anybody throughout that flow? Make sure that FinCEN and others are satisfied with it. So it comes together kind of as a whole in how do you make these faster payments. It's not a single entity that can do it, but it's an overall ecosystem, and that ecosystem is really fired up, really moving in that direction. We're seeing a lot of movement on it, both in large corporations all the way down to almost the small P2P type customers, which is more of at a retail level, but all of it is coming together almost in a single solution. The industry as a whole is moving that way, in that direction very quickly.
When we talk about faster payments, faster settlement, you can't have a conversation these days without blockchain coming into the mix. And I think all of us on stage are asked almost daily our opinions on the viability of blockchain for corporate payments in general, what the use cases are, who's doing what benefit does blockchain represent, and what is it not well suited for. And I want to spend the last bit of this panel discussion on that topic. As I said, we probably couldn't get away without bringing it up. And then we'll have a chance to open up for questions. But before we start, we've been given an opportunity to have another polling session here. The information on how to use the polling system is up on the screen now. And our question really is about your organization's involvement with blockchain at this point. So I'll move to the next screen. Using the contact information that's here, if you could indicate, those of you who wish to participate, Whether your organization is in a research phase only around blockchain, whether you are entertaining or have started some kind of proof of concept, or whether you're actively developing applications that you intend to use going forward, whether you are doing that in concert with others through some kind of consortia, or whether you've got no activity at this time. So we'll see the numbers change. In the meantime, we'll like to move on to talk, myself and the panel, about blockchain. Anywhere we go, there's a different level of understanding about blockchain, and there's certainly not time here today to define it and go through all of its attributes and the pros and cons. For those of you who haven't been introduced to blockchain, it is simply a database that exists on the internet that can be updated by participants in real time, and those real-time changes are shared with the other participants on the network. What this means is that you don't have to rely on a central counterparty for the books and records and to record the movement of cash or some other asset. It is information that is updated, maintained, and made available to the participants on a network in virtual real time in some cases. Now, what this means is that you're creating a single source of truth that is visible in a short amount of time to the participants in a particular type of business. And the information that is written to this database is immutable, meaning it cannot be changed, and it has provenance, meaning you can trace the holding or the ownership of that asset backwards in time because of the way this technology is written. So it doesn't take long for a financial services person, after they hear terms like single source of truth, immediately available, immediate settlement, immutable, for their eyes to start lighting up and their mouth to start watering, because it could pose solutions to many of the cost and inefficiency problems that we have in our institutions, in our business today. So there's been this desperate attempt to apply the best parts of blockchain to these inefficiencies, these problems that we experience in our day-to-day life as we support these products. The jury is still out as to whether commercial payments is going to be a use case that gets traction in the industry. There are 2 or 3 blockchain companies that have made some headway in recommending blockchain for certain areas of commercial payments. We can cite Ripple. I'm sure many in this room have talked to the people at Ripple about their ability to streamline and speed up cross-border payments. The remittance industry of sending money overseas, because it is rife with fraud and overcharging and lost funds, and because it is suspect in terms of AML and KYC, has been another use case that has been suggested for blockchain. This illustration here, it repeats what I just said. We have an opportunity to bring others that are outside of the payment stream now into the payments flow, such as our auditors and our regulators, who can see the transactions in real time and who can audit them or view them and avoid the need for self-reporting or forensic lookbacks that are required by the auditors and by our regulators on a regular basis. So as I said, not time here to go through all the potential benefits of blockchain and some of the drawbacks of blockchain. You know, there are others in my business that are available to have those conversations with you. But the group here with me today deal with these situations on a daily basis and have opinions that I'm sure they'd like to share about you. And then we'll open up for questions, time permitting. So in this, Christina, I'll pick on you again and just ask for your feelings about this hypothesis that this new technology is going to deliver meaningful change into the commercial payment space.
Sure. I think we've seen in the news just lots of different big banks and others in the industry playing with blockchain, developing some really cool concepts in financial services, and I think that's great. I think that related to commercial payments, at risk of sounding like a broken record, I think the payment itself is relatively well served. Whether it's a card payment or an ACH payment, perhaps with the exception of cross-border, by and large, the payment transaction itself is relatively well served. But the data that facilitates the business and processes around the payment is lacking tremendously right now. And I think that there's opportunity for blockchain to potentially solve some of that, to have, to reduce the middleman and to have a decentralized ledger for holding and storing company credentials and authentication and details around payment transactions. This could be revolutionary in the future. I think there's a long tail for this technology. We've already talked about the fact that commercial tends to be slower in adoption, even to consumer. And so I think it's many years down the road, but at minimum, blockchain forces us to think differently about the way that we deliver products and services, about the type of technology we should be looking to in the future. And this kind of traditional model of building new products and services and features on top of legacy infrastructure may need to change. And blockchain may very well be that disruptor of disruptors type of technology that can really solve some of the problems that the nuts that we haven't been able to crack in commercial payments. And I really think the value there is, again, it's in the data.
Ross, in your job, you need to keep an eye on what your competitors are doing, what your peers and aspirational peers are doing, and maybe you could share a little bit of real-world information about what are banks doing about blockchain, what's real about blockchain within the banks today?
Yeah, I think as it relates to commercial payments, I think most of the banks right now are going through what are practical and scalable use cases. So whether that's about cross-border payments, whether it's around capital markets, security exchange, et cetera. You do have the R3 consortium, I think it's 42 banks globally working together to define those use cases. But I think right now, as it relates to commercial payments, it's currently under review, I'd say. But I think we'll take a long, hard look before anyone starts coming out with developing new capabilities to affect commercial payments.
So, Collin, I'll give you the last word on this. Put your fortune teller turban on and put yourself, say, 10 years in the future and look back. And what have we done with this technology looking backwards? What would be your forecast?
Yeah, so very much like Ross was saying, a lot of what we're seeing in the market today is everybody's looking at it, everybody's interested in it, but we're not seeing huge amounts of action right now. And within fintech, as most people know, any kind of new technology, any kind of rollout is going to take a while. And especially with blockchain, because you're going to have that network effect, which means you can't just have one or two players play in that arena. You really have to have a network. And that's going to take time. So I think in 10 years, I think we're going to have a better understanding of where it can be used. I think you're going to see it actively used in a few niche areas. But at the 10-year mark, I don't think you're going to necessarily see a massive rollout and impact industry-wide that's going to have overwhelming implications for how commercial payments are done. I think you're going to see a lot of the benefits that are seen within blockchain will potentially be addressed by the other providers in the market, whether that's the card networks, whether that's the ACH or wire networks of SWIFT and others. And they're already looking to do some of that and stay competitive. But I do see a huge amount of potential in blockchain. We see that actively today. There's a lot of money from a VC standpoint being poured into blockchain around research. We're seeing the banks doing a lot of research, a lot of lab work on it. But it's going to take 10 plus years before you start to see real, true industry-wide impact. So it's probably going to be more like 15 years before you kind of get there, just to set everybody's expectations.
Yeah, and at PwC, we would agree. There are other use cases that are getting traction much quicker in areas where there is no good central counterparty, where there's not efficient clearing mechanisms, where there's not a good information exchange network. We see use cases that you would not have expected for innovation or for automation just 5 years ago around precious metals, around private stock. And so we've got more optimism around those asset types moving onto blockchain than we do cash in the near future. So we would agree at PwC with the other things that have been said on this panel. So I hope that this has given you an insight into the business of commercial payments, some of the things that are driving change in this part of our industry, the challenges that that's placing on the service providers, the networks, the banks, and the fintech companies, and how those fintech companies are looking to exploit these opportunities working with the banks, and in many cases competing directly with them. And to hear how the banks are reacting by taking advantage of these challenges to reinvent themselves, whether it's through blockchain or other more conventional means. There has been a resurgence in innovation in our industry, and we're changing our stripes. We're changing the way that we work on innovation and move product to market. And I hope some of that was made clear through the conversation that we had up here today. We do have 0 time for questions, but I'll break the rules and open it up for a couple of questions if there are any. Yep, over here.
Products and services that you have, what is it that you're looking to do around customer service? Because as these products come to market, they need to be serviced. I mean, from the problems that are going to be arising. What do you guys see as a challenge from a customer service standpoint of view? And then my second question would be, how are you going to go about linking customer service, IT, and the products and services that you develop to make sure the consumer or commercial are able to deal with whatever issues they have arising, if that makes sense?
I'll exercise my right as moderator to point this at one particular. Ross, I'll ask you to step in, and maybe I'll follow up.
I think the client has to be the center of everything. There needs to be consistency, whether you're talking about deploying a new capability. There are going to be multiple capabilities that our customers will be using, especially at SunTrust, that it has to be consistent. And so that operating model, whether it's the customer servicing, whether it's the IT, the technology, et cetera, it has to be a consistent, uniform customer experience every single time.
Mm-hmm. We see investments in getting a single view of the customer, bringing all of the account relationships that customer has across the financial institution to a single place, whether that's a relationship manager or a call center or on the web, giving them that consistent view across all. We also see investment in capabilities and training on some of these new products from front through middle all the way to back office, so that you might have someone in the back office that's assigned to your account. And if something were to go wrong, they're the ones running around like their hair's on fire to make sure that you as a customer is treated in the way that you would expect. So,
Tim, if I may. So what we're also seeing is one of the side benefits of faster payment and more instant payment is you're getting a more instant notification back. So in a customer service environment today, when you're talking retail payments on card, as soon as that payment's made, you have real-time feedback. Did the payment go through? Did they mistype the card number? All the different things. So you're going to start to see a lot of those benefits be pushed into the commercial payment side. So as they execute a mass payment of 10,000 payments, within a second, maybe 2, they're going to know exactly which payments did not post and did not occur. So when an Uber driver calls up and says, I did not receive my payment that I was told I was going to get today, that customer service agent already has it right then and there. And additionally to that, very much like we were talking before, with the faster payment, with the new technology that's coming out, there's much more capabilities to push and standardize additional data all the way through that system. So for instance, within that card payment, potentially, when the consumer or that driver calls up, they can say, I received the payment, and at the end of the statement, here is the number for which I'm calling about. And all of a sudden, that pulls up all of the screens that customer service agent needs in order to take care of that individual or that customer from that standpoint, right then and there, whether it's a small vendor, large vendor, or anything in between.
Other questions? Okay then. Well, thank you, panel. Thank you for your attention.
Thank you.